The gray market, also known as a parallel market, is a place where shares of a company are bought and sold outside the official trading channels. A typical example of a gray market is a small business selling merchandise of a particular company even though they are not the authorized dealers in the market. But it is important to note that the small businesses doing this are legal entities. While the gray market is an unofficial market, it is important to understand that it is not an illegal market. In comparison, a black market deals with goods that are generally smuggled or banned to avoid paying import duty and other charges. Since stocks are bought and sold in the stock market, like any other market, a parallel market exists here too.
Usually, companies that decide to launch an IPO explore to test waters in the gray market. They do so for various reasons, to check the demand for the impending IPO or to gauge what the IPO valuation should be. This unregulated marketplace was established to trade stocks waiting to be listed on larger exchanges or to trade those unable to qualify for the big exchanges. Some gray market stocks are issued by startup or spin-off companies looking to test the waters before spending the time and money to be listed on a major exchange. There might also be stocks which at one point traded on the big, recognized exchanges but have since suffered financial misfortunes or failed to meet Securities and Exchange Commission requirements. Although gray markets are not illegal, they are not authorized or controlled in the usual way. That means SEBI, stock exchanges and brokers are not involved or back these transactions taking place in the gray market. Therefore, there's little legal recourse available to parties if the stock tanks.
Gray markets have been in existence for a long time, and many investors and traders vouch by it. That's because it can be an excellent opportunity for retail investors and traders to purchase the shares before they are listed, if they feel that the stock is going to increase in value. It is pretty much a demand and supply situation. Another reason is that if a customer wants to exit the IPO even before it is listed, the gray market provides her a way out. It also allows people to buy IPO shares even though they missed the application deadline, or if they want to buy even more shares than the IPO application could provide them with.
Gray market premium is the price at which the shares are being traded in the gray market over and above the issue price. For instance, let's assume the issue price for stock X is 200 rupees. If the gray market premium is 400 rupees, it means that people are ready to buy the shares of company X for 600 rupees, that is 200 plus 400. This is how a typical deal works out in the gray market. A stock with positive gray market premium, which is consistent in nature, represents higher strength of giving handsome listing gains. Negative gray market premium or shaky GMP with huge volatility represents caution over the current pricing of that particular stock. To sum up, as stated earlier, the gray market is an unofficial market. For an investor, the gray market premium can be best seen as an indicator of how the stock performs after it gets listed.
Now it's time to reveal something which is not known to many. As we all know that there are no free lunches in the world of finance, so there are no holy grail formulas. However, with an advancement of data science, we could get relatively higher confidence on performance of IPO. Our team had studied IPOs launched in India for over last 12 years in the last week of November 2021, where we have seen more than 275 companies testing the market. Out of these companies who issued stock for the first time, 2/3 companies registered positive listing gains. We have categorized these companies based on their subscription numbers as on November 2021 and figured out that not a single company have registered a negative listing gains if IPO is subscribed for more than 50 times. As the number of times over subscription enhances, probability of earning higher listing gains increases. If we consider That one has invested 100 rupees in all IPOs, then value of their 100 rupees investment will turn to 127 rupees on the day of listing for IPOs getting oversubscribed in the range of 25 to 50 times, and it will turn into 137 rupees if oversubscription falls between 50 to 75 and keep on increasing as subscription multiple increases. Here, our team has averaged all the IPOs falling under same subscription bracket for simpler understanding.
Trust friends, you are enjoying this journey of exploration with us. We seek your support in spreading this information to as many as you can so that our agenda of building this free of cost but full of value course for our viewers. We are committed to make such interesting educational series and help to build financial awareness, however same cannot be done without your patronage. Thus, requesting you to kindly subscribe to our channel and hit that bell icon so you will never miss any notification on our new video launch.